Scan this. Sovi is here. Let's level up. Bond prices change based on market conditions and interest rates. We will analyze how savings and investment shifts impact these values to find the answer.
Bond prices and interest rates share an inverse relationship. When market interest rates fall, the fixed payments on existing bonds become more attractive, which naturally drives their market prices much higher.
A decrease in investment spending combined with an increase in household savings creates a surplus of loanable funds. This shift in the financial market puts significant downward pressure on interest rates. Since interest rates fall due to higher savings, the price of previously issued bonds must increase. This makes option B the logical final answer. Well done! Scan the code. You can learn better with Sovi. Watch signs to avoid rush. Always trust given data and check steps carefully.